Today, folks, I'm going to reveal to you what I did with my Tesla gains as I fully reinvested them into this market as we review my $300,000 portfolio that's now probably inching below the 300K mark as the markets just struggle to hold on to any gains in the midst of a very pivotal earnings season. As we're going to take a look at, the earnings that have just passed, the ones that interest me anyways. We're going to review the portfolio, take a look at the Tfsa, the Rrsp, see how the positions are doing, and then look at what's coming up next week as we are in an absolute shitstorm for just catalysts when it comes to geopolitics. We have an election cycle coming up. We're in the midst of earnings and interest rate cuts and inflation data. So this is so fascinating that if you are on this ride to financial independence to perhaps one day retire early like I am, consider hitting that subscribe button to join me on my journey and hit that like button while you're down there. We'll talk about Tesla. We'll talk about these positions. But firstly, let's talk about what has happened because, man, we had some really interesting earnings. We're going to talk about ASML, J&J, some of these that we already highlighted the other night. However, we had Netflix post, and Netflix has been sputtering after it posted those earnings. It looks like a little heartbeat palpitated just a little bit, enough to get you excited, but nothing really happened. Even though, their forecast came in a little bit, I think, lower than people were expecting, which caused the stock to initially drop, but the earnings were great, and the forecast, in my opinion, is still great. We're talking about double-digit growth here. I mean, year over year, 16.8% is nothing to be ashamed of by any metric. I mean, look at their diluted earnings per share. I mean, you go back and they were trading in the $3 and $2 range, and now they're trading in the $4 and $5 range. Like, they are absolutely crushing it. And for kind of a subscription as a service like business in this day and age, you got to be growing at double digits to justify the values of this market. And that is what we are so far seeing out of a lot of these tech companies. Even though ASML, I'm blown away, has dropped this much, might just be a sign of frothiness, people looking for catalysts to sell, because there's some news they're claiming dropped the stock and it wasn't exactly related to earnings, because for the chip giants on the forefront of an AI revolution, these numbers are still insane. I mean, this is quarter over quarter data, by the way. This isn't like year over year. These chip stocks are growing so effing fast that they really just show you what last quarter looked like versus this quarter. And from 5.2 to 6.2 effing billion dollars, you gotta be kidding me. You gotta be kidding me. Like, they're still crushing these numbers, folks. And net income, look at this, from 311 to 401 in one quarter. This company's doubling. If it keeps this up, it'll double this year. Every 4 quarters, this thing is doubling. So they're claiming that the global chip stocks, from Nvidia to ASML, fall on geopolitical as Trump comments on dealing with China, barring a lot of these companies' sales. I don't know. Like, we could say that this is what's been driving some of the volatility, but these stocks are going to be volatile. I mean, we are in the midst of something really weird going on where mega cap businesses, not me or you, obviously, we just use products like Facebook, or we buy things on Amazon, and then Amazon takes our money and they just give it all to ASML. They give it all to Nvidia, and then Nvidia just boosts their profits and revenues for as long as this continues, right? And it's only going to continue for so long because things are going to change. These companies will either start making their own chips, they're going to find ways to diversify because they ain't going to be giving these companies the drug dealer like returns they've been getting forever. I promise you. Don't know how long it's going to last. It's just a waiting game. You quote me on it. Come back to this video, baby. I mean, we can keep making money for a while, but it ain't going to last forever. Can't be making this kind of money without people perking up being like, how do I do this? So we got Johnson & Johnson here. I don't want to hear about patents or any of that crap. People don't care about that stuff. People always find a way around. Go look at Amazon, Meta. They're all making their own chips. I'm just curious to how that scales or what that looks like over a long term. But anyways, Johnson & Johnson on the dividend front here, folks. Get off my soapbox here. J&J actually did surprisingly well from a stock standpoint. I mean, it's up 3.4% on the back of what wasn't the best net income earnings. However, revenue was great. I mean, for a legacy company like this to get 4.3% revenue growth when companies in the pharmaceutical sector like Pfizer were absolutely devastated from certain drug segments, I mean, this is still great. The only thing killing them is their net earnings. I haven't really delved too deeply into what's kind of crushing the EPS by 5.9% here. It's not completely abysmal, but they are trying to boost some sales here. I think they're offering a little bit better guidance. I'd have to double check, but I feel like J&J is just one of these boring stocks that's kind of been underappreciated in this market environment, as many dividend companies have, which is why on the backdrop of even not the best earnings, they're still able to rally, right? Whereas companies like ASML, these hype stocks, get a little hint of concern and they can drop so dramatically. But on the other spectrum too, we have these banking companies like American Express. We'll talk about Bank Corp, US Bank Corp, because that's the one that Warren Buffett sold. And American Express is down. Again, these companies rallied so aggressively this year. There's no surprise that even on good earnings, they're dropping. This is the reality of why you don't play earnings. They're very risky. They're very sketchy. But I'm shocked at how good these numbers were. All in all, I mean, revenue grew 8%, net income is up 39%. These companies are very stable, very residual. The rail system for paying with American Express or MasterCard, Visa, whatever, these companies have been proving that they are probably some of the best businesses on the planet. They will continue to be highly stabilized businesses, incredible long rates of return here. Honestly, are they expensive? Not really. I mean, with the earnings they're posting here and the net income growth, I wouldn't claim them to be that expensive. Well, I mean, American Express. We haven't looked at MasterCard or the other ones, but I'm saying this looks pretty, well-rounded to me. But let's talk about US Bank Corp. Because this one interests me because Buffett sold it. It was in the SCHD, the ETF that I hold. And I was curious because people were really trashing these regional banks because they got devastated. Unlike the mega banks, they have not fully recovered yet, but they're on the path to recovery. I mean, they were up on their earnings. And let's take a look at these earnings because honestly, nothing that exciting. I mean, this bank didn't really post anything crazy going on. Obviously, their net interest income up slightly here. Nothing crazy. It looks like they were actually making more net interest income, back in 2023. I didn't see anything here that like super excited me other than if you just take a look at, we've got diluted earnings per common share here. They were up to 97 cents, which beat the last 2 quarters. So they are adding more to the bottom line, which is quite impressive considering if we just take a look at their total revenues, the revenue, grew over Q1 of 2024 over last quarter, but over Q2 of 2023, down slightly, but still we're in a place where revenue is starting to kind of accumulate here with these regional banks. So it's nice to see that they're bringing their earnings per share growth kind of back here, which is great to see. Again, we're not in the position we were back in 2023 of Q2. Let's just take a look at Q2 of 2024 versus Q2 of 2023. Just taking a look at the net income here. I mean, we can see that 1.8 billion. I'm presuming these are in the millions. Yeah, so 1.8 billion versus 1.6 billion. We're still not in the best place on a year-over-year basis, but the company is starting to recover. It's finding a bottom, I think, which is a sign of hope for a lot of people in these regional banks, which I'm really curious by. It's crazy that the lower half of the banking sector got so devastated, yet the upper half is benefiting so greatly, which is why it's important to own the mega cap banks. I think, like I said, they're like Pokemon cards, especially here in Canada, the US. You get, your JP Morgans, your Bank of Americas of the world. I don't think you could ever do wrong owning those kind of stocks, but rounding it into my portfolio, kind of what I've been doing here. Like I said, the portfolio today is just hovering around this 300K mark with some of the cash that I have. I did take those funds from Tesla. I don't like sitting on that much cash, and I don't want to wait for tech to correct. If it does correct enough, I just start cost averaging back into it because, again, I'm still working. I have a good savings rate. I'm constantly going to be buying stocks. So I'd rather just get that money to work where I think it's going to be most appropriated over the next 1 to 3 years because, again, we're looking for gains, stability, and I see that in SCHD. I still think we're in a play for recovery for dividend stocks, especially in the Canadian markets, though there's going to be some volatility here. I just think it's less volatile than tech companies are going to be, at least in the next, at least through this earnings cycle. I could be wrong. They could rally back, sure. They're a bit frothy in my opinion, and we're starting to see that frothiness cause some volatility in the VIX. Earnings are going to be interesting. We'll see what happens, right? But for now, I took that money, and let's take a look at the accounts because within my Tfsa here right now, I'm only holding VDY and VOO. I'm a very boring investor. For the most part, most of my money is within 3 ETFs, but it gives me a crazy amount of diversity, right? And luckily, VDY, since I changed over some of my Tesla gains, I dumped a huge, a good amount right into VDY here, and we're up 1%. VDY has actually been doing pretty well. It's been rallying, especially over the last 5 days. We've got 1%. Nothing crazy, right? But in the scope of Tesla dropping from 260 where we sold it, we're managing to maintain a lot of those gains, and that's kind of the goal, right? So same with SCHD, which we'll take a look at because VOO is the only other position in my TFSA, and it's kind of been obviously petering to the downside, which I did buy more with some of those Tesla gains. But within my Rrsp, SCHD, guys, has been crushing it. SCHD has been having a roaring come back here, hitting some recent highs. You know, it kind of peaked its 2022 all-time high finally, and we're sitting at over 81, you know, bucks a share here. Still, I don't know what it's at right now. If we take a look, I mean, yeah, we're still around 81. If it stays above 80, I'm happy here, because in my RSP we kind of surpassed that 90K mark, which was super awesome on the Canadian converted side. Take 60, you know, we're sitting on, you know, 65,000 US dollars here, trying to get this to about 100,000 Canadian dollars, which we should be able to do next year no matter what, with the contribution, the attributed contribution limit we should be allowed. But very excited, right? I mean, I'm a very boring and simplified investor, and I'm very excited to see what my July gains are going to look like, because man, between the extra gains we squeezed out of Google, the extra gains we squeezed out of Tesla now, the 40% pump, we should be on the inch of outperforming, especially now that the market is turning around. You know, when the market takes these dips like this, and I have a lot of more stable assets than what's going on with tech. Again, these are short-term moves. I can't predict that that's what it's going to be for the long term. You know, this is a constant game of adjusting for me, while also trying to maintain a long-term passive income investing strategy. And I know when I make these videos, people kind of get all up in arms that, oh, you're trading this, you're doing that. And again, materially at any given time, I'm messing around with about 10% of my portfolio. That's it. I mean, in the grand scheme of the last few years, you know, at the most, except for the exception of that major drop in 2022 when I adjusted into index funds, I really do not play with the bar soap as much as it might look like. I'm a very stable, slow and steady investor. As my dividends now get to that 7,000 annual mark, which is interesting. Again, I'm not too oriented into the dividend side, but the end goal is to try and get my dividends to be around 3% of the entire portfolio. I want about 3% income. That's where I feel like the stability is for me. If I can just get 3% income, get some good growth vectors in here with the S&P 500, I'm in a good spot. You know, 3% is a lot of capital to reinvest in case the markets dip. It gives me some income if I need to spend it. It's there. It's just nice to have, right? I feel like that's my happy medium. So where do we sit moving forward, right? I mean, we're taking a look at a lot of pivotal earnings next week that are going to fascinate me. Verizon being one of them, insight into the telecom giants, how they're doing. We got UPS coming up on Tuesday, along with Tesla and Alphabet and Visa. Whew, baby, it is going to be pivotal for that. So we're getting the major telecom giants like AT&T next week. It's finally some big tech earnings. American Airlines is posting. AbbVie is going to post. Next week will be the real week that I think kicks off, whereas this week was just kind of an introduction to what's really going to happen next week. And I think it's going to be good. I think for the most part, you know, we'll get to see what's going on in the auto industry with GM, Coca-Cola, some Warren Buffett favorites, Waste Management. You know, RTX, Southwest, so many great companies are posting earnings that we need to pay attention to. But honestly, from what we've seen so far, I think it's going to be good. I think if there's too much froth in the market, as mentioned, tech will continue to sell off no matter how good the earnings are. But we don't know. Like, again, I can't tell you. I don't have a crystal ball. I just feel out what feels right for me. And in the short term, that might seem right. In the long term, it might be wrong. Maybe in the next year, Tesla pumps on robotics and I miss that gain. Or who knows, maybe Tesla drops enough and I start buying it back. I don't know. Like I said, I can only do what I do. This is not financial advice. It's just entertainment value from my personal perspective. But I'd love to know what you think in that comment section below.